Okay, Friday, March 20th, 2020, around 2:43, and it's been a actually pretty crazy day on the market. It opened up higher, and now it's going lower, and personally, I think Wall Street's just too complacent. I'm actually glad to see it down in this afternoon, and not that I like down, but I like rationality, and I just think Wall Street's been too complacent. And I'm a little bit more fearful. That's just the reality. I'm not a cheerleader. I'm trying to just figure out what's going on. Too many pundits come on TV. Like, this is the reason for, I believe, there's complacency. This whole video's on that. But guys keep coming on TV, on CNBC, and they're super bulls. Like, every guy comes on, one guy after another. Oh, it's gotta buy, you gotta buy, you gotta buy. No precautionary measures, no hedge your downside, maybe nibble a little, like something. Like, I mean, they're literally bull after bull after bull. I'm sure there's some bears out there, but they're not bringing them on TV. And just the fact that the media is willing to do that tells me there's just too much complacency. Just the trading too. It was up this morning, which made no sense. On Thursday night, California, all 40 million residents shutdown. I think they called it a shutdown. But you could only go out for essential things. Earlier in the day, New York State said, unless you're an essential worker, meaning like you're in hospitals or you're delivering food and stuff like that, you must work at home. 100%. 100%. The market's barely moved. It started to now, but it didn't move immediately. Usually these things, something like that comes out and it's immediate. Just the fact that it didn't open up down from the California news was too much complacency. I'm telling you, I just think there's more downside. And I'm not trying to be negative. I'm just trying to be real. I guess I am trying to be negative. I'm trying to make an assessment. I'm not, normally a bear. I'm usually a bull. In fact, on pullbacks, I'm often a bull. Like, let's get back in. This is different. This is akin to 2000 in the tech wreck, or 2008, the housing crisis. I think this could be worse, frankly. Okay, so let me just let me pull up. We got CNBC on here, and let's pull that up here. Getting pretty good at this.
Productive things happened tactically yesterday. Sounds like you don't expect this bounce to last for long.
This was this morning, by the way.
What we've ever been. I guess you could go back. Some people.
Okay. Sorry, I'm interrupting the feed there, but this was this morning before the market opened. You can see actually on the screen now that the futures were up and it was going to open up. And Kramer just said, and I was talking over it, this is the most oversold we've ever been. I don't know if that's true, but that's what he said. Okay, let's watch more tape.
We'll say, just get some great stuff from Mr. Williams, who's one of my absolute favorite technicians. Larry Williams, everybody uses him. I just want to point out, because he's done work which says, going back to 1933, this is one of the most extreme panics ever, and he wants to buy panics. And the other...
Okay, pause. He wants to buy panics. Going back to 1933, this is the biggest panic ever, and he wants to buy panics. That's complacent. He's too complacent. He's coming out here saying, oh, it's time to buy it. It's supposed to be this world-renowned technician that everybody uses, according to Kramer. Okay, first of all, no offense to technicians, but your stuff doesn't mean a damn thing in this kind of market. It just doesn't. And neither does my valuation stuff, by the way, which I believe in religiously. I think it's more than religion. I think it's science. I think we're literally doing the mathematics of how to value something. But in a market like this, you got to use common sense at this point. You can't just, take a chartist, a technician, or even a value guy like me. You got to use some more common sense. All right, let's keep rolling here. By the way, I don't mind Kramer. I am not a Kramer basher. It's easy to pile on to someone on TV and be negative, but I think Kramer's good. He's decent. He's usually a perma bull, but he's decent, and he's also very good at couching these in a political manner, as you'll see. He's a savvy media guy for sure.
On the other hand, you come back and you say, well, who's there to buy? I really feel that we're due for bounce. There are a bunch of buy recommendations today. I just don't know how much money there is around there to buy more stock, and I think that liquidity is the concern in every aspect of finance. At the same time, anytime you skip over the public health issues, you forget that right now the strapped in San Francisco, strapped in Boston, strapped in New York, maybe the chief issue that we have to deal with. There's just not enough equipment. The nightmare's occurring.
So what do we make then of Stiefel looking for a 15% rally by the end of April?
Keep going there.
Black, of course, yesterday saying no longer net short for the first time in years. Scott Minerd today, we're in the value zone. You mentioned the slew of upgrades, which we'll get to, but why are there these little pockets of, I won't call them optimism, but bullishness to some degree?
Well, I don't know, Carl. I mean, somebody called yesterday in the lightning round and they asked me about
Okay, there you go. Listen, Stifel, they're all in. That other firm, I forget what it was, took off all their hedges. A slew of upgrades. I'm telling you, man, this is a big issue. This is not a minor issue. I'm actually glad, I had planned to do this video because earlier in the day, everything was green. I'm actually glad to see it go red in this, see some rationality here. This is not over, okay? It's just not. And by the way, if you're a client of mine, you're about 35% cash now, so that's pretty good. I'm pretty happy about that. Okay. I now want to go to I'm going to look at some charts here. 2000. I think this is a 2008 chart. No, this is not. That's 2000. I'm going to do that after. Just go back to 2008. So listen, I feel very fortunate at this point to have experienced the year 2000 and the year 2008. I mean, it wasn't fun, but I feel like I can draw on that experience in this market. Okay, so I was pretty young in 2000. I had just kind of finished business school. I worked at Deloitte and Touche for a couple of years, and then I was working at an investment bank as a research analyst. But I was still pretty young and still kind of naive, frankly. So here we are. I want to show this chart, and this I do like these Yahoo charts, but they're kind of wild because the scale changes and lots of movement. But here we are back in 99. This is November where my cursor is, and just skyrocketing towards the end. This was really the dawn of the internet. I mean, it started before that, of course, but this is when it was, browsers were available and you could actually have an online business and things were going crazy. And this is unbelievable. The Nasdaq. This is the Nasdaq. Went to 5,000 in 2000, in the year 2000. So this is March 2000. Yeah, is that right? Yeah, March 2000 right here. 5,000. Hit 5,000. It's only 7,000 today. So that's what, 20 years ago. Yeah, it's 2020 now. 20 years ago. No, it didn't last. It did not last. Okay, but look at this blast out. This look at this. Boom. This was only, what, a month worth of, yeah, mid-April. So this was March 9th was the peak at 5,000. By April 17th, it had hit 3,000 something. Come on. 3,300. 3,300. So 5,000 to 3,300. That's a big hit. You get the same kind of thing back then. Oh, you gotta buy. In fact, it looked pretty okay for a bit. Okay, I want you to remember that number. 3,300 after a massive pullback, washout. That's got to be an buying opportunity. Okay, now again, the scale is going to go all wonky on me. So I'm trying to bring this 3,000 point right to the edge of the screen, and then we'll see how much further down it went. So that's the point right there. Okay, so all right, roughly speaking, I've got there's the 3,000 right on the edge of the screen, and then we continue to go down all the way till April 2001, where it hit 1,600. It was still half, down half. So the crash started in early 2000. We're now a full year later, and it's 2001, and it hits 1,300. That's right. Excuse me, 1,600. Whew. I think it got a little worse. Yup, it got worse. Look at this. By September, 1,400. I thought it went down to 1,000. That was my recollection here. Oh, there we go. Oh yeah. Here we go. 1,100, and we're talking 2 years later. 2 years later, it hit 1,100. The Nasdaq went from 5,000 to 1,100. Took about 2.5 years, because this is towards the end of 2002. You tell me this little pullback here that we've had, this roughly 30%. I mean this is the Nasdaq, and it was overblown. Okay, so let's say, oh yeah. I think some people would say, oh, that's the Nasdaq. Well, what about the S&P 500? Because that was just a bunch of internet startup companies that blew up. All right, fair enough. Let's take a look. We'll add in S&P 500. Okay, let's go back to 2000. Okay, so now again, the scales go all over the place. So clearly, well, you'll see, there was names you could get into that weren't in the internet, right? So that's kind of the peak. And if you'd stayed in other names, you would have done okay. But look, see, yeah, so Nasdaq is doing worse, but the S&P is still going down. S&P 500 still was going down. What was actually? Let's go back to that peak again. Okay, there's the peak. The S&P was at. We'll use this peak right here. That was, where's the number? Oh, 1508. Okay, 1508. All right. That was March 2000-ish. Okay, a couple years later. Oh my goodness gracious. 2000. Still, okay, let's use this little bottom here. So this is September 2001. 1,000. Just 1,500 to 1,000. So 1,500 to 1,000. That's a big drop. 2 years later. Let's see, we keep going here. It got worse. 800. That's half. Are you telling me a global pandemic, shutting down New York, shutting down California already, Italy's on lockdown, there's been some good news in China that they've made some recovery. Just look at that time frame right there. That was brutal. Okay, that was brutal. All right, now, I'm trying to. It sounds like I'm scaring everybody here. 2008 housing crisis. Okay, right before the crisis, right here. 1561 S&P 500. Let's just say 1,500. Okay. Housing crisis. Bam! Here's this big drop here. That was a huge drop. Down to 899. That's something like 40% drop. Okay. Oh, it's got a buying opportunity, right? Gotta be. Well, it continued to go down to 683. We're now a full year later. No, sorry, that's 6 months. Excuse me. So from the peak, which was October-ish, 2008, yeah, to the bottom was March 2009. That's like 6 months, okay, roughly. There was, I think, an easier cure. It was a financial cure. Inject some money into the economy, into the banks. Make sure the banks are solvent. That was the fix. You can't fix a global pandemic that quickly. Not that I know of. I've actually, I've changed my view a little bit as well. I didn't think it was a big a deal at first. That's all. I mean, people are getting sick, but the death rate's not that bad, and it's bad. It's bad. I've changed my tune. It's bad. Okay, we do not close down entire states with 40 million people, unless there's something serious. Okay, so I think Wall Street's just too complacent. And it's one more little piece of evidence. As I said, the market was up today at the open. It's actually acting a little more rationally by being down now, I think, which I think is good. Companies that were being bought were like the Costco's and Kroger and things like that, which makes sense. That's rational, right? Costco, people are running to Costco. I think here in Canada we can buy Loblaws and Metro and stuff like that. Okay, so Kroger today, at least last time I checked, this could be changing as we speak. Kroger was sold out. Yep, Kroger's down 6% today. Okay, so this is going to be not quite consistent, but earlier in the day, Kroger was down, but the market was up. So people were clearly selling out of their Kroger to buy more risky assets, right? I don't think that's rational at this moment. I don't think that's smart. Personally, I think it's too early. It's just too early. We don't know how this is going to play out. If I knew how, I am not willing to come on like CNBC. I would not go on national TV and say a year from now we're going to be up. That's not what I just showed you. 2 other crashes where it took more than a year. Well, one was 6 months actually. The other one was 2 years. But we're only. Okay, middle of February is when we hit it. We're kind of at a high there. Well, now middle of March. 1 month. Even if it goes more like 2008, that was 6 months. 6 months! And it was down 56%. If you think the financial crisis is more severe than a pandemic, then maybe you could buy. I'm not convinced a pandemic is not worse than a financial crisis. Okay? So anyways, Kroger, as I was saying, is down because people are using that as a source of cash to buy other things. Same with Costco. Let's see, where's Costco at now? Costco's down 4%. Now the whole market's down at this point, so that kind of using that to buy other things. It's kind of out the window a little bit, but Clorox is another one. Clorox, which I think is rational that people bought Clorox in this environment. Clorox is very good. By the way, I would never buy a company just based on this pandemic. I'd buy it as a bonus. Yeah, Clorox is down 6%. People were clearly selling Clorox as a source of cash for something else, in favor of something more risky. So I'm all over the map here. I said I would never buy something like Clorox just for the pandemic. Clorox is a fantastic company you can own at any time. I'd own that for the next 10 years. It has nothing to do with the pandemic. It's a bonus. So that's okay. That's the kind of thing you should buy. I think in Canada, Loblaws and Metro, they're fabulous companies. Regardless, we don't need a pandemic to buy them. If you think you're just buying it just because of the pandemic, bad idea. Here's another good one I like. Gilead. Gilead was a great company, had some issues. Some of their drugs came off patent, and The stock was going down for about 2 years. But it stabilized. And then the pandemic came along, and they actually might have a solution for that. They're still testing, lots of stuff to go. But it was time to buy it anyways, and then you get maybe potential solution for this pandemic. So that's the kind of thing I would buy. So I'm looking at Gilead's down 6%, which again actually was down earlier in the day while tech was going crazy. People were selling a potential cure for the pandemic with a good company anyways as a source of cash to buy riskier assets. I don't think it's rational. Anyways, I've gone on long enough. I think we got some more downside to go. That's just my opinion. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or a retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.